now to take you further into the future of the Shanghai Composite, we're joined by Brendan Ahern in New York City. He's the CIO of KraneShares, a financial consultant group focusing on Chinese investment. And in our Washington, D.C. studio, we're joined by Scott Kennedy. He is Deputy Director of the Freeman Chair in China Studies at the Center for Strategic and International Studies. He has a broad knowledge of China's economic policy and its global economic relations. I want to thank both of you for joining us. So why don't I start with you? First, some numbers look like so much gloom and doom, and yet the Shanghai Composite marking its biggest two-day gain since 2008. So it's bouncing back. Two other markets also rebounding. But put all of this into context for us. Chinese stock market, only a small part of the economy, isn't it? I mean, what's the impact here?
Sure. I would say broadly speaking, because finance from the stock market is just about 3% of total finance in China, it doesn't have a monumental impact, but it does indicate sense and anxiety about the direction of economic policy and about the government's commitments to market reform, and also worries about the valuation of these companies, which had risen a lot in the past year as a result of a whole variety of government stimulus measures. So that explains the bubble bursting. The question is at what pace it's burst and what the floor is. And the intervention of the past week seems to have settled markets, stopped the blood flow, and we've seen the uptick in the last couple of days.
Yeah, the pace, the flow, all of that, and where is the floor? That's always a question. Brendan, why don't I start with you?
Sure.
Your thoughts on the government's response? Just enough, not enough, too much?
No, this is most certainly a financial crisis, and as we've seen from central bankers across the globe over the last several years, a crisis requires a heavy hand by regulators to help keep the market stabilized. We've seen that in Japan, in the European Union, as well as here in the United States. Regulators and policymakers in China have implemented, over the course of the last several weeks, incremental increasing in the dosage of the medicine, so to speak, starting 3 weeks ago. It had a minimal effect with the market continuing to decline following the interest rate cuts we saw. So then the subsequent week, 2 weekends ago, we saw a further increase in brokerage houses, mutual fund families coming in and buying securities. We've also seen the halting of new initial public offerings. So we think that the regulators are taking a very measured response, but that it is necessary, and that if the crisis were to deepen further, it's very much welcoming from the part of investors to know that there is a steadying hand at the wheel. So
you'd say measured, so just enough. In your estimation, they've done just enough?
Yeah, I think they're very much focused on the where we saw very high valuations, frothiness within the mainland markets was really within the small cap as well as the Chinex stocks. The large cap names have really just recently returned to their long-term valuation averages. So the large caps never really participated in the frothiness that we believe within KraneShares. We've stayed invested in the blue chip large cap state-owned enterprises. We've been telling investors to try to avoid the small caps as well as the Chinex companies because of these very extreme valuations in many cases. And I think you have to step back and realize that the markets over the course of the last year are still up a very significant amount, and pullbacks and corrections are very healthy for any bull market. And while we're apt to see potential some volatility in the short term based on stocks that had been previously halted coming off, we are optimistic that China's economy is still growing. 7% is the envy of the global economy, and you have a healthy backdrop for stocks, though. So in the short term, it's hard to tell exactly where that floor of support by the regulators and policymakers are.
Yeah, I'd have to agree with you. 7%. There's a lot of countries that would love to have 7%. Scott, let me point to you. Do you think the government's done enough, or maybe too much? What are your thoughts?
Well, I don't think it's a question of too much or too little. It's sort of the type of tools that they've used. I can understand where they might have created they've created a fund to soak up some of the shares, and also stop new IPOs, and maybe suspend some of the trading. I think those are reasonable measures to do. Encouraging students to say that the market is good and should go up That's a lot of, that's good fun, but probably not too helpful. It probably wasn't necessary to tell major shareholders or SOEs that they couldn't sell shares for a while. So I think the question is, it's always hard to know exactly what is enough, but the long-term goal is to make this financial system able to stand more on its own 2 feet so that the regulators don't have to come in every time there's a problem and provide reassurance. You should get reassurance by understanding that it's a stable market and a healthy economy.
Let me throw this question out to both of you because Brendan was talking about this frothiness and warning investors. I heard one analyst today saying that these stung investors basically playing a lot of hunches, going on instincts. And it was the equivalent, he was saying, of going to a major university, paying your tuition, and you got a really good lesson out of the whole thing by losing a significant amount of money. A lot of these people borrowing money to get in. Is that the takeaway from this, that perhaps people were learning something about the market that they should have known beforehand? I mean, it can be dangerous.
Well, the lesson is two-sided. One, they know it's risky, but they also learned that if the market falls enough, the government will intervene. You'd like to get to a situation where even if the market falls off, people understand that it's a gamble, it's a risk, and they would accept those, and that would make them be more conscious when they bought in the first place. But it's very difficult to position to get there. China's in the middle of a long-range reform plan, and to say no more government intervention ever under any circumstances is nothing that any government would do, because as the other guest said, even in the United States, we've also intervened in our markets on occasion.
Yeah, we saw that with TARP, obviously. And Brendan, I'm going to ask you the same question. Is this kind of a lesson? I mean, we saw the same sort of thing here in the United States with the dot-com bubble bursting. A lot of people jumping in, buying stocks like crazy, thinking they were going to make a ton of money, and then finding out the reality is sometimes that doesn't happen.
No, you know, we've maintained our investments in the large cap blue chip state-owned enterprises because we believe in that reform agenda that is taking place. I think where investors in China have learned an unfortunate lesson is that margin is really leverage, and compounding works both on the way up as well as on the way down. And certainly that cascading effect of margin calls within particularly the small cap and the Chi-Nex names is a very difficult lesson. I do believe that financial literacy will be an end beneficiary to investors in the long run. Certainly, I believe that further reform of both the margin policy, both directly regulated by the brokerage firms, as well as negating non-brokerage financial institutions providing very high levels of margin. If China should and deserves to play on a global field, and in order to do so, we're going to have to adhere to, say, global standards. And the one area where we believe that further improvements can be made is that use of margin and the halts. I think it's important that regulators and policymakers are continue to be as transparent about why this has been necessary. Because certainly halts and suspensions, some foreign investors might look somewhat skeptical on, but I think it's many investors aren't as attuned to what's taking place in China today and the seriousness of the situation. And I think as long as there's further transparency by the regulators and policymakers on why they've taken these extreme measures during this time of crisis, that will be a good thing for China in the long run.
Well, Brendan, we're going to leave it there. Brendan Ahern joining us from New York City. Thanks so much. And Scott, we want to thank you for joining us here in the studio. Appreciate it.